Welcome to Talk Tickers, your weekly deep dive into the latest earnings calls. Today we're looking at Hippo's Q2 2025 earnings. Management actually called this quarter a pivotal milestone.
Yeah, and the market definitely seemed to agree. The stock reacted pretty positively after the call.
Absolutely. So our mission today is to really unpack how Hippo managed this turnaround, from those big losses to actually hitting profitability and what that might signal for you about tech in the insurance space. So let's just cut right to it. What were the numbers that really jumped out this quarter, the ones that screamed turnaround?
Well, the bottom line is probably the most dramatic place to start. They reported GAAP EPS of 0.05 cents.
5 cents positive compared to last year.
Exactly. Last year, same quarter, it was a loss of $1.64 per share. So a massive swing.
Wow, okay.
And then on an adjusted basis, it came in around $1.65 per share positive. Analysts were expecting 65 loss.
So they beat by $1.30. That's incredible.
It's a huge beat, yeah. Absolutely demolished expectations there. Revenue was also strong, $117.3 million.
Which beat consensus too, right?
Yeah, by about 1.6% and up 31% year over year. So solid growth. But it's that profitability swing that really signals the shift, moving from just growth to disciplined operations.
That's a remarkable shift, no doubt. Okay, so beyond those headline profit and revenue numbers, what underlying metrics really back up this idea of a fundamental change?
Right, because you need to look under the hood. Gross written premium, or GWP, that grew a healthy 16% year over year to $299 million. So they're still writing more business.
Okay, solid growth there.
But the real eye catcher, I think, was the consolidated net loss ratio. That tells you how much they're paying out in claims versus the premiums they collect.
And that's been a key focus area for them, hasn't it?
Absolutely. It dropped to 47%. 47.
From what level?
It was 46 percentage points higher last year, so a massive improvement, down 46 points year over year.
46 points is huge in insurance.
It really is. And beyond that, adjusted net income went from a $20 million loss last year to a $17 million gain this quarter. And maybe most significantly for the long term, they posted their first ever positive net income from operating activities.
First time ever. Wow.
Yeah. And just quickly, their cash position improved too. Cash and investments, excluding restricted funds, went up by $76 million just in the quarter to about $604 million. So financially, much stronger.
Okay, that 46-point drop in the loss ratio is just, frankly, staggering. Let's unpack that. What were the big strategic moves that drove these kinds of results? Management called it transformative, not just good.
Yeah, they were very clear on that. A really big piece was closing the sale of their homebuilder distribution network. They sold it to Westwood.
Right, I saw that for $100 million.
Yep, $100 million total. $75 million cash came in right away, and the rest is due in Q1 2026. That deal alone is expected to add about a $90 million gain in Q3.
90 million gain. Okay, so a nice cash injection.
Definitely helps the balance sheet, but it's more strategic than just cash. It lets them accelerate diversification, move away from just being a distribution channel.
And focus more on
their core strengths, their underwriting, their tech, their hybrid fronting programs where they partner with others, but use their tech platform. They're doubling down on where they think their real edge is.
Okay, that makes sense strategically. But connecting that back to the loss ratio, how did shedding assets or getting cash actually help them manage risk better and tighten up underwriting so dramatically?
Well, the sale itself frees up focus, right? But the loss ratio improvement, down to 47%, that came from very deliberate actions on the insurance side.
Like what specifically?
Significant underwriting recalibration, basically getting much stricter about who they insure and the terms, making precise rate adjustments across the board, and improving their claims handling operations.
So tightening the screws everywhere.
Pretty much.
Yeah.
And if you look just at their main product, the Hippo Home Insurance product, or HHIP, its gross loss ratio improved to 44%.
44%.
Yeah. And the non-PCS part, that's losses not related to big catastrophes like hurricanes, so more like regular fires, water leaks, that kind of thing, that was down at 34%.
Really low.
Extremely low. And management made a point of saying that even if you strip out the benefit from prior year reserve releases, money set aside for old claims they didn't end up needing.
Like those can sometimes flatter the numbers.
Exactly. Even without that benefit, their net loss ratio would still be well below their long-term target range of 60-65%. So it suggests a real sustainable improvement in the underlying book of business, not just a one-off.
That's a crucial point,
Yep.
sustainable improvement. Okay, so they're managing risk better. But what about efficiency? You mentioned revenue grew over 30%. Did costs just grow along with it? Or are they showing leverage?
That's the other really compelling part of the story this quarter, the operating leverage. It really shone through.
How so?
Well, while that revenue was up over 30%, their main operating costs, think sales and marketing, tech development, G&A, those actually decreased by 16% year over year.
Decreased while revenue soared.
Exactly. So those core operating costs as a percentage of revenue dropped from 46% last year down to just 30% this quarter.
That's significant leverage.
Absolutely. It shows the platform is scalable. They also hinted at using AI more for ongoing efficiencies. The key takeaway is they expect fixed costs to grow slower than their premiums going forward. That's how you drive profit growth. Better risk selection plus more efficient operations.
Okay, that combination is powerful. You mentioned AI. Lots of companies talk about AI efficiency gains. What makes Hippo's approach potentially different or more likely to stick, in your view?
It's a fair question. I think two things stand out from what they discussed. First, they have a lot of specific data from focusing on especially new homes for years. That gives their AI models a strong base to learn from. They're not starting cold.
Right, data is key for AI.
Definitely. Second, they seem to be targeting it quite specifically, not just, sprinkling AI everywhere. They mentioned using it in claims processing to speed things up and improve accuracy, and using predictive analytics and underwriting to pick better risks.
So focused application, not just hype.
Seems that way. They seem aware of the trap of trying to automate everything at once. Instead, it's about hitting high-impact areas that directly help lower that loss ratio and cut operating costs further. That focus plus the data gives them a better shot, I think.
Okay, that makes sense. So we've seen the improved health, the tighter underwriting, the efficiency gains. Looking ahead, how does this translate into their guidance for the rest of 2025? What are they telling investors now?
Well, the raised guidance across the board is a really strong signal of confidence. They bumped up the low end of their gross written premium target, now expecting between $1.07 billion and $1.9 billion for the full year.
Okay.
Revenue guidance now $460 million to $465 million. But the really big moves were on profitability and loss ratio.
Right. What did they guide for the loss ratio now?
They significantly improved it, now expecting a consolidated net loss ratio between 67% and 69% for the year. That's down from the previous 72-74% range.
That's a big improvement baked into the full year.
Huge. And the bottom line guidance is even more dramatic. GAAP net income. They now expect a positive $35 million to $39 million for the full year.
Positive. What was it before?
Before, they were projecting a loss of $65 million to $69 million, so a massive swing in expectations there.
Wow. Okay, that's a $100 million plus swing in outlook.
Pretty much. And adjusted net income is now guided much closer to break even, between a $4 million loss and zero. So big steps towards consistent profitability.
That really underscores the pivotal milestone idea. But, no plan survives contact with reality perfectly. What potential headwinds or, let's say, known unknowns did they acknowledge that could challenge this rosier outlook?
They were pretty transparent about a couple of things. They flagged near-term revenue headwinds, specifically from that Baldwin transaction we mentioned earlier.
The homebuilder network sale.
No, sorry. Baldwin is a separate large distribution partner. The sale was Westwood. With Baldwin, the restructuring means they expect about $5.5 million less revenue in Q3 and $6.5 million less in Q4 compared to what they previously thought.
Okay, so a near-term dip from that partnership change.
Exactly. But they stressed the long-term benefits, wider distribution reach, access to more new home closings should outweigh that short-term impact.
Makes sense. Anything else? Seasonality.
Yeah, they did note, as you'd expect, a seasonally higher non-PCS loss ratio likely in Q3. Summer weather, storms, that sort of thing often pushes those up. But they expect it to improve again in Q4.
So typical seasonal patterns are baked in.
It seems so. The fact they called it out suggests it's already factored into their improved guidance. The biggest risk, as always for property insurers, is just an unexpectedly severe catastrophe season. But they seem confident in their modeling for now.
Got it. Okay, stepping back from the quarterly numbers, how are they positioning Hippo within the broader homeowners insurance market? It's been tough for a lot of players with climate issues and costs rising.
Yeah, they acknowledge it's still tough for consumers out there. But they do think the industry overall is starting to reach rate adequacy, meaning premiums are finally getting closer to covering the actual cost of risk.
So maybe the worst of the rate hikes are behind us industry-wide.
Possibly. Or at least catching up. Interestingly, Their longer-term view is quite forward-looking. They suggested that maybe major weather risks like hurricanes or wildfires might eventually need to be insured outside standard homeowners policies.
How would that work?
Perhaps using things like parametric insurance, where a policy pays out automatically if a specific event trigger is met, like wind speed hitting a certain level, rather than based on assessed damage.
Interesting. So separate policies for specific big risks.
Potentially, down the road. For now, Hippo's strategy is focused on significantly reducing their own exposure to those big weather events within their main HHIP product and building a more balanced overall book of business where homeowners is just one part, not the whole thing.
Diversification is key.
Exactly. And they're really targeting customers who are maybe buying new homes or who are very focused on proactive protection, using smart home devices, preventative maintenance, that kind of thing, to reduce risk upfront.
So leaning into the tech and prevention angle. Okay, and one more strategic point. There are partnerships with MGAs managing general agents. How do they decide when and where to take on risk through those partners, given this renewed focus on discipline?
Right. Those MGA partnerships are crucial for their growth and diversification. Their approach seems very measured, built on years of experience in that space.
Oh, so?
Typically, when they partner with a new MGA, they start on a fully fronted basis. That means Hippo provides the insurance paper, essentially, but takes very little, if any, of the actual underwriting risk initially.
So they let the MGA handle the risk first.
Yeah, they observe. They only start taking a piece of the risk themselves once the program is matured, once they have enough data, and once they're really confident in that MGA's ability to underwrite profitably.
Data-driven decisions again.
Exactly. And they're actively managing the mix, adding casualty lines, for example, to balance out property risk. And importantly, they're not afraid to cut ties. If a program isn't meeting their standards, even if they're just fronting it, they'll put it into runoff.
Disciplined approach.
Very much so. It reflects a cautious, selective expansion strategy. Only participate where the data shows a clear path to profit.
Okay, that makes a lot of sense. All right, let's shift gears. It's time for our This Is Not Financial Advice segment. We've heard the bullish story, the turnaround, the raised guidance. Purely as food for thought, what kinds of potential market narratives or speculative trade ideas might spring from this?
Okay, keeping the not financial advice disclaimer firmly in mind, given Hippo's really strong Q2 and clear operational improvements, especially when you compare it to the broader P&C insurance sector like the GAAP ETF, which tracks P&C insurers and has been kind of flat to down lately.
Right.
One outrageous but plausible idea could be a long position in Hippo, paired with a tactical short in a broad P&C ETF like Kai.
So betting on Hippo specifically against the sector.
Exactly. The thinking is that Hippo's showing unique execution, a successful pivot. It's demonstrating it can potentially decouple from the broader sector, which is still facing more general headwinds. It's a bet on their specific story winning out.
It's interesting. Playing the specific company strength against the wider industry. Got another one.
Yeah, another angle, playing more on their specific guidance and the seasonality they mentioned. You could consider a tactical short position on some broader P&C insurers, maybe ones known for higher non-PCS loss exposure, specifically for Q3.
Okay, short the sector or parts of it for Q3.
Right, and pair that with a long position in Hippo, looking towards Q4. The rationale builds on Hippo explicitly guiding for those higher seasonal losses in Q3, suggesting it's already baked into their numbers and managed.
Well, maybe not for everyone else.
Potentially. The outrageous part is shorting insurers during Q3, which can be volatile with storms. But the plausible part comes from Hippo's stated confidence in managing through it and improving into Q4. So you're betting on their relative resilience and outperformance as the year closes out.
Betting on their predictability in an unpredictable season. Got it. Okay, fascinating ideas. Definitely food for thought. And that really wraps up our Talk Tickers deep dive on Hippo's Q2 2025 earnings call. A quarter that definitely seems to live up to that pivotal milestone label. We saw that impressive swing to profit, strong GWP growth, and crucially, that dramatically improved loss ratio.
Yeah, all driven by some pretty decisive strategic moves on capital, focus, and underwriting discipline.
So the big question left for you, our listener, to ponder is this just one strong quarter for Hippo, or is this journey from restructuring to profitable growth actually setting a new kind of template, a new way for tech-driven insurers to navigate and maybe even thrive in this challenging P&C world?
It certainly offers a compelling case study for how it could be done.
Absolutely. Remember, everything we discussed today is for informational purposes only. It is not financial advice. Always do your own thorough research and consult with a qualified financial professional before making any investment decisions. Thanks for tuning in to Talk Tickers.